Good morning and welcome to another exciting edition of Business Law. Yeah, we got a few things to talk about today, chapters 14 and 15. We're really starting to wind down. I mean, can you believe you've been through a big portion of the text? So, man, it's done pretty well. So, um, discussions, still just keep reminding you more is better. I'm getting, it looks like maybe an average of 2 per group member. And I think some group members are kind of dominating and others not doing so well. And I occasionally get an outside person commenting. And once again, as we get towards the end of the semester and you start wondering about extra credit, your opportunity for extra credit is fast diminishing, right? Something I set up at the beginning, and I said use it early and use it often. That contributing to discussions to which you were not assigned would add for extra credit, as would maybe submitting articles or things that you might like to have included in the discussions. And I've had a few of those from some students, and if you're out there, I have a record of those, don't worry. Even though I haven't accounted for them, they'll be accounted for at the end of the semester. So, in fact, this week, the one for Group 4, Montana doctor charged with 2 counts of negligent homicide, kind of interesting, and that was submitted by a student, so awesome. There was an article in the paper this morning, and I may get a transcript of it, and it may be one that I include here coming up. In fact, I may even put it in place because it's timely. A company called, oh shoot, now I can't remember their name. It's a restaurant company. And they just filed a Chapter 11 bankruptcy anyhow, and they have lots of branches, lots of units in Great Falls, 2 or 3 if I'm not mistaken. They own Chili's and On the Border, I think, or a couple of those. And they just filed for a Chapter 11 bankruptcy, and so give us an interesting, in fact, it's a Montana corporation. Apparently, because they filed for bankruptcy, they listed their address as Cascade County. So that one might show up, and that's a subject that'll be coming up soon. So it might be interesting to put that one in there. But for now, let's talk about try to get through this. Again, we got a couple chapters. This one's pretty. Oops. I started. Let's start from the beginning. How about? This one's relatively short, so we'll get through it pretty quickly, and then I'll probably send out a separate video with Chapter 15. But this Chapter 14, we talk about corporate governance and business organizations, and there's a few things that are really important here, and that's, understanding the tax implications, I think, of the various organizations, and also understanding the liability implications for the various corporate organizations and the people that are involved in those. Those are huge. They're just extremely important. Okay. We break things down to closely held or private. It'd be good to put that in there, and I should. A closely held organization or a private organization is owned by family and or friends, or just a small number of people. To say that it's only family and friends is probably a misnomer. It should say just a small number of people. Generally, it could be it could be 100. I think at our bank, for example, it was privately held, meaning that it's not publicly traded, but we had well over 100 shareholders, that owned the stock in the bank, and still do, I'm sure. I think the banks bought back a decent amount of its stock to try to limit that number, but there's probably still anywhere from 50 to 100 shareholders at Independence Bank anyhow, but it's still closely held. And I still have a few shares in there, and I can tell you that I'm not necessarily friends with everybody else. I don't even know who they are, but it's still considered closely held. So a publicly held one is one that's traded right on the public stock exchanges. So think Apple, Microsoft, GM, even smaller companies, and there are some here in the state that we're familiar with, like Glacier Bank, Stillwater Mining, Northwestern. You get kind of limited. Pretty soon you run out of ones that are publicly traded that are maybe headquartered here. First Interstate Bank is. We're getting there. That's getting to be there's another little bank that's publicly traded that's out of Helena, and I can't remember what the name of it is, but which is not a basic form of business. Corporation is, partnership certainly is, and sole proprietor certainly is, so we'd probably, using the ruling it out method, we'd probably get down to the unions or not, right? So what are the factors? Oops. Cost of creation certainly is a key factor, and a lot of businesses, when they start, you don't even think about the type of entity, and that's fine. You don't necessarily have to. You don't have to write up an entity agreement if you're going to start a lawn mowing business, right? You can head out and start mowing lawns. You can use your own social security number. You can do those types of things. You don't even need a separate employee tax ID number, okay? Then you'd file taxes as a sole proprietor, and you'd fill out a Schedule C on your tax form, and that'd be it. Your cost of creation would be none. On the other hand, if you had some other issues, liability issues and things like that that you wanted to consider, you would pursue another type of entity. Okay, the continuity, stability, or dissolution of businesses is important. Corporations, for example, can live on forever, right? There's corporations that have been around. GE, for example, that's just been around forever. Okay, and even though the original owners obviously are long since dead, the company still exists. Control of decisions, whether or not to go public, is a huge deal. Hang on, I'll shut this off, hopefully. There we go. Just unplug it, and I don't have to worry about it going off anymore. I should have unplugged it beforehand. As a corporation gets bigger and adds shareholders, whether it's public or private, the control of the decision lies ultimately in those shareholders, and those, of course, that own 51% or more can certainly have what would be called a controlling interest. Okay. Owner liability. Again, liability and taxation, I think, are the two bigger ones that kind of come up. And if you're a college kid that's just starting a lawn mowing business, you're probably not terribly concerned if somebody sues you. If you do something incorrectly with your lawnmower business and you cause some harm and somebody sues you, you don't have a lot to lose anyhow, right? What are they going to do? Take over your student loans? Probably not. And so it's not too big of a deal. But as you grow and prosper, and you also maybe accumulate more personal assets, protecting those assets can be important, and certainly you can do a certain amount of that through insurance, but at some point too, you need to, you may want to address it through a limited liability company of some sort, and we'll talk about the various types. And then taxation. Taxation is huge, and we use entities, or entities are used to save a lot of people, hopefully, taxes, and they each have advantages and disadvantages when it comes to taxation, and we'll talk about some of those too as we go through it. So here's a pretty good chart, probably in your book, and so something that you may want to look at and understand, right? Here's the liability issues, right? In a proprietorship, it's unlimited. In a general partnership, and I wish they had that as a general partnership, it's unlimited, right? In a limited partnership, the general partner's liability is unlimited, but everybody else's liability is limited. In an LLP, limited, LLC, limited, etc., right? So know these, and know the tax issues that a C corporation, and it's not labeled as a C corporation, but maybe should be. This one down here in the bottom left should be called a C corporation, and the C corporation has what we call double taxation. And all of our publicly, but virtually all of our publicly traded companies are C corporations. Okay, I would also add that this thing's not perfect either, because partnership doesn't need to have an agreement, at least not in the state of Montana. Other states it might differ, I don't know. Okay, but in the state of Montana, you can have a partnership easily without having any type of a written agreement. There's no requirement for that, so that's important to note. Okay, so sole proprietorship's easy to create, right? Okay. Greater continuity, well, until the person dies, of course. So I don't know why they would put greater continuity there. That's interesting. But liability, anyhow, As a sole proprietor, you have unlimited liability, meaning that if something happens in the course of your business, you can be personally responsible for that, period, no matter what it is. Okay. Flexible tax planning, what that means is that you're not double taxed, but it also means that all the profits or losses of that sole proprietorship flow through, I guess how they term it, it flows through to whoever that sole proprietor is. So if the business makes $20,000, it doesn't matter how much money that sole proprietor takes out of the business, they're going to pay taxes on the $20,000. Partnerships are much the same, at least general partnerships are. As a sole proprietorship, it's just that you have more than one person, right? Could be 2, 3, whatever. And we set those up, right, because there's a common business interest. And again, the share of the profits or losses, those flow through to the partners, whoever they may be, and in totality they flow through, and it's in proportion to your ownership, right? So if it's 50-50, that's easy. It might be 60-40, right? And that's fine. Creation's simple. Again, in the state of Montana, no requirements, okay? I'm in at least one partnership, and we've never had an agreement. Probably silly, but you know, it's worked, so that's fine. Each partner has an equal voice. Maybe depending on how the partnership's set up, I think you can set up some unequal things, especially if you got like a 60-40 interest or something. Continuity. It's dissolved when ownership changes. Now, dissolution kind of has a little different meaning. For example, my partner and I, you know, if something happened to one of us, say something happened to me, technically my partners in my partnership would be dissolved, right? But that doesn't mean certainly that my wife wouldn't pick up my share and in essence form a new partnership, even without agreement, but form a new partnership with my current partner. Okay, that would be very common. And so while sure technically the partnership that we have is dissolved, a new one would be formed almost automatically in that case. So liability in a general partnership, again, it should be labeled as a general partnership, is joint and several, and that means it's unlimited. And not only does it mean that, it means that if my partner were to do something in our partnership, in the things that we do in our partnership, if he were to do something that would create some liability, I would still be could be held personally liable for that. Okay, so certainly we try to cover those things with insurance and other types of things. At some point in time, that we may want to move into another type of an entity too, for liability's sake. Taxation according to the level of ownership. So again, it's prorated, you know, based on 60-40 or whatever. I think when it says each partner is an equal voice, it's an equal voice as to your level of ownership, maybe is what it means. So corporations, domestic and foreign, I think we're talking about states here, right? Corporations are creatures of states, are set up and chartered in the states. And a domestic corporation is one that would be chartered and doing business in your state, right? A foreign one is one that's chartered someplace else, but still does business in your state. Creation, you have to do a charter. It is somewhat expensive. Again, it kind of depends on the complexity of the corporation, but somewhat expensive. So you know, a lot of corporations, especially publicly held corporations, are actually incorporated in Delaware. Delaware apparently set up a law years and years and years ago. This is what I was told when I went to college, which is years and years and years ago, but that whatever any other state passes to make corporations easy to form, our law will automatically change to adapt to that. And so a lot of corporations just, that's where they are chartered, is out of Delaware. That doesn't mean that they can't do business. Northwestern Energy, for example, which does its business just about entirely in Montana, is chartered in Delaware. Okay, that's fine. Nothing wrong with that. And there's a lot of Fortune 500 corporations and those that are actually chartered in Delaware. it can be somewhat expensive. Continuity, we talked about that. It can be perpetual. And publicly versus closely held or private, we've basically already talked about that. The nice thing about corporations is liability's limited. Okay, and when we say limited, it's limited to your investment. So if I put in $100,000 to help form a corporation, and the corporation gets sued, I'm limited to that $100,000 liability. Right? They talk about piercing the corporate veil in the alter ego theory, and what they talk about there is, especially in small corporations, if my personal actions cannot be separated from those of the corporation or my actions within the corporation, then they could maybe come after personal assets. That would be if the person, the individual, did something egregious, wanton and willful, and all those other terms that we use in tort discussions. They could pierce the corporate veil and go after individuals. Happens, I suppose, at times. It's difficult to do. If you're running your business just as a normal business and in a normal course of business, generally you're provided with limited liability. I shouldn't say generally, almost always provided with limited personal liability. And this talks about corporations, and we got to know too that there's two different types of corporations: S corporations and C corporations. Hopefully we'll talk about each of those. So how do we control, right? Shareholders, they ultimately have the control over a corporation, and they elect a board of directors. Shareholders can also look at issues that might come before the company. And if you go to a shareholders meeting, somebody gets up and presides over the meeting, and if you're a shareholder, you have every right to vote, right? And there's nothing wrong with that. And oftentimes your vote, the main vote that you make, is for the board of directors. They tend to be a little more operational, but they hire officers that then actually run the company, right? And who hire employees that do all the dirty work, of course. You should, if you're a holder of any stock in any company, they have to have annual meetings, and you should receive notices of those. I get a notice every year of the annual meeting for Independence Bank. I almost never go because I usually have class or some other conflict that keeps me from going, which is unfortunate because they have free coffee and cookies, and I'm all up for free coffee and cookies, even if I have to sit through a boring hour-long presentation about what the bank did in the prior year that I can look up online anyways. Okay. What else was I going to say there? Something else. You should anyhow. You also get a proxy statement. So if you can't attend the meeting, you can fill out the proxy statement and assign your vote to somebody else that could vote for that. And there can be issues. Sometimes those issues are noticed ahead of time, and so they'll let you know, and you can even vote on them maybe ahead of time. When you send in your proxy, you can say, well, I give Bill the right to vote my shares, but here on this issue I'm voting this way. And for the board, these are the folks that I'm voting for. So you can do that too. Corporate taxation. Corporations, and again, let's talk about a C corporation, right? So businesses or corporations, C corporations, are taxed. Every state, I believe, has a separate corporate tax. There might be some that their corporate tax is zero, but the federal government certainly has a corporate tax. I think it's 35%. And we say the C corporations are double taxed because not only that, the corporation pays a tax, and then when it pays out a dividend, then the shareholders also pay a tax. Right? And so we say that corporations, C corporations, are double taxed. How do you avoid it? Well, on a closely held one, right, you could pay salaries, reasonable officer salaries, expense accounts, those types of things. C corporations, while they're generally used for bigger corporations, and they do that because they want to attract an unlimited number of investors. S corporations have a limited number of investors, but C corporations actually locally are very popular because for farmers and ranchers, this works out really well, this little subheading right here, this employee shareholder expense account, because if you're a farmer or rancher, there's nothing wrong then with hiring somebody right, to stay on the place to mind the farm or ranch, or to, you know, make sure the land doesn't blow away, type of thing. Okay, and as a result, the household expenses can be written off. Okay, and so that's a little bit of a quirky thing that C corporations have. And so a lot of farms and ranches, they'll at least have an operating C corporation. Might own the land and stuff where the house and whatnot sits, and they pay then, right, the owners to stay out there and take care of it, and they can write that off, and they can write off the groceries and other things like that. So those are the two main things that C corporations are used for, right? Big companies to attract lots of shareholders, and then smaller companies. Capital structures, equity versus debt. We've talked, well, we don't, you guys haven't yet, but debt's always cheaper, so you know, but debt also provides issues of risk. And I talked a little bit about the Chapter 11 and that company. Gosh, what the heck was the name of the company? Yeah. Anyhow, how they have a significant amount of debt, and going through Chapter 11 bankruptcy now as a result of that, right? Can you accumulate earnings? Sure, corporations can accumulate earnings. They can retain everything and never pay a dividend. Berkshire Hathaway, one of my favorite companies and people to talk about, Warren Buffett, his company has never paid a dividend. Ooh, well, why would you want to own that if it doesn't pay out any money to its shareholders? Well, because the value of the stock continues to grow. And in that case, I don't have to pay taxes on it, or an owner of that stock doesn't have to pay taxes on it until such time as they sell the stock for a capital gain, profit or capital gain it's called in those cases. Now, corporations that have a limited number of shareholders can also file as a subchapter S. A subchapter S corporation basically chooses to be taxed as a partnership. So it enjoys the benefits of limited liability and those types of things. It's limited to the number of shareholders, and I think it's 150, might be 75. Okay, I won't test you on that because I don't know myself, and maybe it varies from state to state. But anyhow, in a subchapter S corporation, the profits or losses flow through to the shareholders. Okay, but you're limited, so you can't go out and you can't attract the equity. It's not workable for the farm and ranch. It doesn't enjoy that same status as the subchapter C does in terms of writing off the expenses and those types of things. So subchapter S's are fairly popular for, again, some smaller entities. Probably they used to be more popular than they are today because the LLC came along. So partnerships, we've already kind of hit upon that. You know, a general partnership can have, you know, 2 or more, and everybody is subject to liability, full liability in a general partnership, unlimited liability. In a limited partnership, there can be one, this should be as big as these ones, but there can be one general partner, right? And that general partner then is subject to unlimited liability, whereas the passive investors, or limited partners, we would call these, limited partners are protected. They have a certain level of protection. Now they cannot, by definition, they cannot be involved in the day-to-day then operations of the partnership. That's got to be limited to the general partner. The general partner is generally the person that's there day-to-day and operating the business, and is subject to unlimited liability. So S corporations, we already kind of talked about and kind of hit those, and we're seeing limited liability organizations, or LLCs. And oftentimes we want to say limited liability corporation, and it's not. It's a limited liability company. Okay, it's a non-taxable entity, and what's that mean? It means that, again, just like a subchapter S or a partnership, the profits or losses flow through to the members, and they're called members in an LLC, not shareholders or partners. They're called members. And there's more flexibility than an S corporation. So for one, you don't have to have meetings every year like you do with any kind of a corporation. And so there's just, that's just one example. There's probably others. Shareholders, members, I already mentioned that. And kind of a partnership hybrid, right? And it only takes one person. So one person can have an LLC and enjoy that limited liability, right? While also enjoying the tax advantages of being a sole proprietor, or being, like a partnership type of a thing. And so they've become pretty popular. I know we had in small business management class, we had an attorney and some accountants come in and talk about LLCs, and they said they're really popular. Until fairly recently, there was concerns that they hadn't been fully tested in the courts, but the attorney said that, in her opinion, there have been enough court cases now that have gone through that we're pretty confident about the limits to the liability and the protections in the courts. So each partner in a partnership is jointly and severally liable for claims against the partnership. Again, in a general partnership, that is true. Okay, I need to get in and refine these a little bit. So trends, Dodd-Frank, Wall Street Reform and Consumer Protection Act. Making it much more difficult to start and finance small businesses. I do not hear good things about Dodd-Frank or Frank and Dodd from my old banker buddies that I used to work with and know. A say on pay is saying, should shareholders have a say on the pay of and they do really. And so I don't know. Increased oversight by directors. I think, again, I think we're seeing that a little bit more because of shareholders that are becoming a little bit more active. They're trying to push those things maybe a little bit more. We're seeing, if you watch the business news, you're seeing more activist types of shareholders. Okay, they're coming in and making demands, even though they might have a small percent of ownership. They're making demands of the corporation, and they'll be active and vocal and public about those things in an effort to try to bring about some changes, okay, in the way they're run. There was activists that were involved with eBay a while back because they wanted eBay to spin off PayPal, which it did. PayPal is a separate corporation now. So use of deferred prosecution agreements, that's when they're, of course, going after some of these corporate malfeasance and some of the folks that work in those places. Deferred prosecution agreements, deferred imposition of sentence. Maybe some of you have heard about that if you got your first MIP and they said, hey, we'll let you off the hook here if you mind your P's and Q's for the next 6 months. And it's basically similar, the same as that. So let's call an end to that one. Hopefully that's relatively quick. It was less than a half an hour. And I'll send you out a separate one on Chapter 15. So thanks, and talk to you soon.